Okay, we're going to discuss exchange-traded funds today. And what I want to get into is specifically is more got to do with the exchange-traded funds on the stock exchange. Very popular. The thing is, but you have to realize what these things are. Now, they're popular, and I'll explain to you why they're popular. I'll get right down to the nitty-gritty of it. Why they're so popular. They're popular because they're a Ponzi scheme. Do you remember in cryptocurrency we had BitConnect? Right? BitConnect. Okay, BitConnect was a Ponzi scheme. It was a Ponzi scheme. But here's the thing. BitConnect, they slipped out without really cheating anybody because they gave you BitConnect coins, which became basically worthless. But when they gave you those coins, they gave you the net value of what those coins were worth at the time that they gave them to you. So they give you your money back. But then the coins went to nothing. So it was like cheating you. But they're going to do exactly the same scheme with these ETFs. So let's get down to the basics. What is an ETF? It stands for Exchange Traded Fund or Exchange Traded Funds. So these are basically funds and they're traded at the exchange. I mean, why overcomplicate things? Let's get down to the basis of what the word says that they are. They are basically they're not slips of paper anymore, but they're like slips of paper. I mean, if we didn't have the computer technology we have, they would be using slips of paper for exchange-traded funds. So basically, they can create as many as they want. It's a Ponzi scheme. It's no different than what we were dealing with BitConnect. It's the same sort of a racket. These are rackets. So what's going to happen in the not-too-distant future with these exchange-traded funds if the market goes down? Well, first off, let's talk about how exchange-traded funds are created. Exchange-traded fund creation. The supply of exchange-traded funds, shares, is regulated through a mechanism known as creation and redemption. So now, we've established what these exchange-traded funds are. They're basically almost like slips of paper that say you own a certain percentage of an underlying asset. The underlying asset being these stocks, right? But it's not the same as the underlying asset. It's a representation of the underlying asset. So the supply of exchange-traded funds, shares, so these are shares. Stocks are already shares. So they're making shares on shares. Ponzi scheme. The supply of exchange-traded fund shares is regulated through a mechanism known as creation and redemption. So now this creation thing, this is a wonderful tool. I mean, these guys that got the creation tool, they can create as many exchange-traded funds as they want and then turn that into money. You know, this is like compounding money. It's like a license to print money. Supply of exchange-traded funds is regulated through a mechanism known as creation and redemption. The process of creation-redemption involves a few large, specialized investors. So in other words, they're not just giving anybody this money creation tool because it's too powerful, right? They're only giving it to a few large, specialized investors. In other words, the banker buddies. Probably the same banker buddies that own the Federal Reserve to begin with. These are known as authorized participants. So, authorized participants in this Ponzi scheme. They are large financial institutions with a high degree of buying power. We are a large financial institution, and we have a high degree of buying power. So, enable us to run a Ponzi scheme for all of you suckers. Such as market makers. That may be a bank or investment company. Only APs can create or redeem units of an ETF. When creation takes place, an AP assembles the required portfolio of underlying assets and turns that basket over to the fund in exchange for a newly created ETF share. Similarly, for redemptions, APs must return ETF shares to the fund and receive the basket consisting of the underlying portfolio. Each day, the fund's underlying holdings are disclosed to the public. So the underlying holdings would be the stocks and bonds that are already, this has been basically tried and proven over the years, but these ETFs, this is like making a credit on the credit. It's like, now here's the whole trick in this whole game. The underlying asset, or the underlying holdings, what they call the underlying holdings here, the stocks and stuff. The holders of those underlying assets really have something tangible, stock in a company, or etc., right? But if you got an ETF, right, so say you're one buyer of an ETF over here, you don't know that the underlying asset is these stocks and bonds. You don't know about the other buyer over here. And the other buyer over here, 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 and the other buyer over here. And they don't know about all that. How much, how many, it's spread out. It's been spread out so far and wide with all these underlying buyers that that underlying asset that covers all that, it's like a game of musical chairs. So you got your main chair, and you got 1,000 people dancing around that one chair. When the music stops, they're all going to want to sit on that chair or have that underlying holding that underlying asset, which is the stock. So the popularity of these things is, this is it's spreading out. It's a Ponzi scheme. I mean, I can't get down to the basics of it. It's a Ponzi scheme. So when the market shuts down, when this market shuts down and these stocks start to get liquidated, because what we'll go through is a margin call, what do you think is going to happen to these ETFs? Well, I can tell you what's going to happen right now. If we go under a market crash, not just a correction, but if we go into a crash, can you say poof? That's what's going to happen to your ETFs. Poof! Just like happened with BitConnect. Poof! Now, I was in BitConnect, and I got most of my money back before it went poof. But that's still a little bit short when it went poof. So they shorted me a little bit. I lost a little bit. I didn't lose a lot. I got most. I got about probably 75% of my money back before they went poof. So I lost 25% of my money on that deal before they went poof. Now, if I get in earlier, I would have made money. Now, a lot of people have made money on these ETFs because they got in early. But you know what? We are coming to the big mother of all stock market crashes, coming right up. We are coming to the mother of all stock market crashes, and the Fed's bringing it on. Now, what might happen is this week, and I'll tell you what really I'm expecting to happen. I'm expecting the stock market to recover somewhat over the next few weeks, because what I think, now this is my personal opinion, I think they've priced in now, at this point, the hike in the U.S. 10-year going up to 2.85 or 2.86. I think they've priced that in now. The stock market's had its little tantrum, pretty much priced it in, and now the stock market's leveling out. It's starting to level out. The volatility is starting to settle down. And I think we're going to see a slight recovery, very slight comeback in the stock market over the next few weeks. Right up until March 20th. I think it's going to smooth out up until March 20th. And then what I think is going to happen is after March 20th, we're going to see a little bit of turbulence caused by an interest rate hike by the Fed around the 20th of March. And then come the 30th of March, the Fed's going to raise the bar on the bonds again. They're going to raise it from 20 billion to 30 billion. And I think that's going to do it. I think what's going to happen is because I think that the bond price is going to start to go up over 3%. And then we're going to get a sudden, sharp market correction. At first, it's going to start as a market correction. Then I think what's going to happen is we're going to have like a 10% correction in the markets. And then what's going to happen is we're going to have a little bounce back to normal in the markets, and then the big crash. When I say the big crash, I mean a crash like we have not had in a long time is going to come then thereafter. And I think if you're in these ETFs, when the big crash hits, they're going to go poof on you. Just what I said, they're going to go poof because it's a Ponzi scheme. So you got a few months left with these ETFs, I think, until we get a giant margin call in the markets and a giant crash in the markets. And I mean a big crash. And then you can kiss these ETFs goodbye. Because they're only a representation of the underlying asset. That's all they are. They don't really exist. The underlying asset, which is the stock, is going to go down tremendously. What do you think's going to happen to you with the ETF? Because you're like musical chairs. You're depending on that underlying asset being the chair that everybody's going to want, because everybody has bought into these ETFs and they don't realize that they don't really hold the underlying asset, which is the stock. They've done the same thing with your silver now at this point. Tremendously in silver and in gold too. They've done the same thing they've bought many paper silver, and they hold it, but they're not holding the real thing. But they think, okay, this is fine because we'll settle for dollars. Boy, oh boy, everything's going to end awful bad in a few months from now. Because this is all coming down in a few months from now. Unless only one way that this is going to be wrong, that's not going to be coming down. And that's if the Fed backs up the bus now. If they decide to throw this thing in reverse. If the Fed decides, okay, we're not going to sell our toxic balance book anymore, we're going to add to it, then things could change. But I don't expect that that's what they're going to do. I really don't. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye.